Hitting record. Welcome to the Real Estate Investment Education Club at Intel. Today is June 10th, 2022, and our guest speaker today is Eddie Speed. So Eddie, I am going to ask you to introduce yourself and let everybody in the room know what you do. And then we can either let you go through the presentation and answer questions at the end, or I could judiciously interrupt you. We often have people put questions in the chat, and I can just judiciously interrupt you, and we can take them as you're presenting. It's up to you.
I'll tell you what I'd like to do. This is a topic that I have presented a lot. And so I think you will find that sometimes people will ask me questions and then 3 slides later, I answer the question.
Yep.
So I would say, whenever you think of the question, type it in the box. Okay. Like, don't stop, don't wait, type it in the box. And let's see if let's see how much of at the end we really got through, because it'll be interesting to see what people's questions were. Right. And then when we don't get through something, then obviously we'll stop and catch it at the end and do that. So with that, I'm ready to start if you guys are.
Go ahead. The floor is yours.
And let's see here. I'm going to share that screen. And how about being your own bank? Everybody interested in that? How do you do that? Right. So a little of my background. I started this industry in extremely challenging times, because I started in the note industry in 1980. And so a lot of the things that we see printed and talked about and responded to today were things that I can tell you that I firsthand experienced, because I started when interest rates were 20%, and I started seeing people using creative financing and the note industry overall. And I believe it is going to come back raging to solve problems in the industry today. Specifically, what I want to show you guys today, this presentation is about a 40-year journey and what I figured out a little bit at a time. I didn't figure all of this out in the first 2 years I was in the business. Sometimes it was 20 years after I'd been doing it, I figured out one more little piece. I want to ask you a question before we start. You can type in the chat box. Do you believe that you can take $100 and turn it into $100,000 you will never pay taxes on in a retirement account? Type it in. I'll be curious what everybody says, because that's the question we're going to ask today. Now, I'm not unseasoned in the business, and I'm not unseasoned as a speaper. So So I would say to you, if I am, I would say to you guys, if I'm asking the question, I probably am going to prove it, but I think it'll be fun to see if people really believe it or not. So I'm going to push through these slides pretty hard. Okay. I want to encourage you guys again, ask me questions on the board. Let me get to them at the end. But I'm certainly not disregarding your questions or your ideas. So with that saying, let's push on here. So by the way, at the end, I'm going to give you guys a book that want to stick around. And this is a question. This is a book that is an Ask Eddie book. And it is probably the 120 most common questions people have ever asked me about this business. Buying notes, creating notes, will a note pay? Is it safe? Is it legal? You know, all of that good stuff, right? All the stuff that people do. So I want to go give you guys a digital portion of the book today, and I'll give it to you at the end. So let me set some framework up. I'm fully aware that I'm talking to a group of apartment guys. Now, by the way, the guy that was my mentor and taught me this business was an apartment guy. His name was Gene Shoemaker in Hattiesburg, Mississippi. He was my father-in-law. So he added notes to his apartment business, right? He did it as a diversification to his apartment business. And you're saying, why does this matter? Because we need diversification, right? What happens at the apartment industry isn't as good as it needs to be? And what else have you diversified in? How about crypto, right? How about Bitcoin, or let's see, how about Tesla? Let's go. My sales manager says he loves for Tesla stock to go down because he can just buy more of it then. Now, I'd call that an optimistic view, right? I'd rather figure out where we're closer to the bottom of the market, right? So I like this business because it lets me have control of something that I fully understand, and it allows me to go have other investments. This is an excellent retirement investment strategy to build legacy for your family, okay? We do have some open mics. So just if I caution you guys, as you come on and stuff, just make sure that you clicked your mic, because we'll have somebody will cough or somebody will say something, or whatever, and they won't mean to, but they'll be on an open mic. So, all right, so let's look at a property seller. Property seller sells the property to the buyer. If the buyer doesn't have all cash, what does the buyer then do? They go get a mortgage, right? Now, we traditionally think of getting a mortgage, and from that, we are looking to go to the bank. How's the bank doing at mortgages right now? Does anybody know? What if I told you that a headline this week said that mortgage applications are at a 22-year low? Last year, the mortgage industry originated $4.5 trillion in residential mortgages. They're projected to originate 2.7 trillion this year and maybe 2.1 trillion next year. How's the mortgage industry doing? Are they solving every problem needed in the market? And the answer is, we're going to see a lot more of this. We're going to see a lot more of the seller being the bank and what is commonly called seller financing. About 100,000 seller finance transactions are created a year. I believe in the next 2 years, Daniel, will easily see that number double. And I mean, it's not a hope and a dream, it's history. Did you know that last year that the average residential seller finance note was $289,000? Did you know the year before that the average size was $180,000? We grew an average loan balance in 1 year of $100,000. So the reason we did that is not just because property went up in value, but more people need seller financing for various reasons. And so we'll see that continue, because seller financing is proven to be a very effective strategy in inflationary times. And when they create notes, they create opportunity for people to buy notes. And that's what I spent a lot of my career doing, is figuring that out. So a mortgage note is basically some components of it. There's a principal amount, interest rate, monthly payments, and amortization term. And then the buyer comes in and he signs that note, puts his John Henry on it. And you've seen it called a seller finance note. You've heard it called paper. You've heard it called a home loan. You've heard it called a mortgage. So if I say any of those things today, it's all the same. It's all the same thing. So let me ask you one basic thing about this whole industry. It's like, why do you do this? Why do people like notes? Look, I helped design the hard money lending system for home investors. I set up the seller finance note system for home investors. I know a lot of guys that do a lot of different businesses, but I will tell you this. The number one reason that people like notes is this. And a lot of times, particularly in the rental space, we get a lot of gross money, but we lack a lot of net money, right? And so what people like about this business is you do work one time and you get long-term income. So I like buying notes, and I've done hard money lending, but hard money lending is a job. And 4 months from now, if you're successful, you get paid off, you got to go do it all over again. So I like this space because it gives me a long-term strategy that people like. A lot of my focus today is on legacy, right? Because I feel like the one impact I could do with your audience, Daniel, is to say, what does legacy look like? Like, generally thinking, when we think of legacy, we're gonna have legacy, and we're gonna teach people our values, right? We're gonna teach people our faith. We're gonna teach people good behavior. We're going to teach people kindness. We're going to teach them benevolence. Those are things that we think of like those are legacy things, and those are very powerful legacy things. And I believe in those things strongly. But what else is legacy? So if we think we want to build a financial legacy for our family, we think we have to start out with a big pile of money, right? That's generally what we believe. In order to end up big, we have to start a little less big. And so the idea that I want to say to you today is I want to let you dream a little bit of what's possible in the business. And this has been my family's life story. This case study is about my family. It is about my wife. And my wife has done this literally a lot of times. She's done it for her mother. She's done it for her and I. She's done it for our kids. And now she's doing it for our grandkids. Another thing outside of the self-directed retirement account is also a health savings account, an HSA account. Did you know that you can take $6,500 per year, deduct it as if it was like interest or some expense that's tax deductible, and put it in an HSA? And basically you can do that every year. And whatever income it ever earns on the backside, you never pay income tax on it. So it's tax-free on the front side and tax-free on the backside. Now that's wild, but most people actually don't know that's possible. What about a Coverdell educational account, right? Coverdell account is where you could send your kids to school, and it can be anything from riding lessons to piano lessons to whatever. They have to believe they're going to do it for a living. But it's all kind of things. You could pay for their computers and stuff. And so this strategy will work on all kind of asset classes, and we've done it. So here is my mother-in-law. My mother-in-law, Nana, we call her. She's in her 80s. My father-in-law died about 25 years ago, and I've helped her run a note business. He started me in the business a long time ago. This is my wife, Martha. That's my son, Wood. He is a fireman and a paramedic, and he works with us in the land business. And this is a picture when his son, Colt is now turning 3, but this is a picture when he's a baby, and sort of resonates the idea. So these are all real family members. Like, this is real. I know you're looking at me going, how did that girl marry this guy? I got it. But somehow for 40 years now, it's happened. So I'll stick with that. So let's talk about the various accounts, right? That you could have. My mother-in-law started out with a very good retirement account. And so Martha has a retirement account. Martha can help our kids with a retirement account, and she can also help our grandkids with a retirement account. Now, in order to do that, one of the biggest objections with growing a retirement account is you don't have a lot of seed money, right? So my mother-in-law can have a health savings account, and you can do this very strategy with a health savings account. My mother-in-law can invest in my kid or grandkids' Coverdell educational account. Now, so can Martha, and so can Wood, and all of them can invest in these accounts. Now, they are limited on how much money you can put into them. Health savings account is $6,500 a year. Coverdell educational account is $2,500. So to take $2,500, you have to do something pretty effective with that to do that. And that's where we've learned to use these strategies. So this is a real case study on an asset that we bought. This is your typical soccer mom in a suburb of Memphis, Tennessee. Okay. House is worth $220. The note was $160. That was the loan balance. It was at 6% interest. The payment was $1,081 a month, and there was 281 months remaining. So the property was worth $220. The note was $160. And so it was a 73% loan to value ratio. Okay. And let's just say that what I like about this is the seller had equity. They had what we'll call skin in the game. So that a lot of times just means on an underwriting variable that you have a pretty solid deal. Okay. That's the buyer's equity. So when I look at a note, I see cash flow. So we bought this note at a discount. It was a 6% note. We bought that note for $105,000. Now, if you plug that in your calculator, you take your financial calculator, it's going to say essentially the interest on our investment per year was just about 12%. Now you're saying, Eddie, is that normal? Is that possible? I will tell you, I've closed 50,000 notes. I bought a whole lot more notes at closer to a 12% yield than I ever did at an 8% yield. So I would say for us, it's normal. If you don't know where to find a note, you don't know how to price a note, you don't know how to underwrite a note, it's probably not normal, right? But it is very normal. And that's why we built a school around this, is because we're able to help people to kind of progress and like, how do you do this? Like, is this real, right? So we bought this note at a discount, and that discount is earned over the life of the loan. So we're going to get the 55,000 back because we bought the note at less than what's owed. So if you really run that through your calculator, that $55,000 discount plus the interest on the entire note, that makes our interest on our investment much higher than the interest rate on the note. That's why you buy notes at a discount, right? So let's talk about risk management, right? Like, what did we pay for the note? The property's worth $220, right? Well, we didn't buy that note at anywhere near $220. So when you take our investment, you got a big cushion factor on top of the deal. And because we bought the note for $105, we're at 48% of the value of the property. Now that's different from loan to value ratio. That's investment to value ratio. So it just gives you a sense of what's our safety net. God forbid something goes wrong. Well, it's pretty good, right? Now, let's just go through like a thought process. Okay, Eddie, I like that note. I would buy that note. I need some help of where to find that note. I would buy that note. I can see it. I like cash flow. Now I want to go through sort of a risk assessment. Now we've talked about investment to value, which is a risk assessment. And we said the loan to value is good. The buyer has almost over 25% equity. They recently have a good pay history. It's in a great neighborhood. You can kind of see that. The title's clear and the taxes are paid. So the buyer is doing their part. They're paying good. The house is insured properly. They've paid their taxes. So that tells you kind of like how much trouble am I going to have here? What are the negatives? Well, most of you would say it's a 271-month investment. It's a really long-term investment. Most people would see that as a negative. I will tell you this, it is not a negative for us, right? Because the longer the term, the greater the discount. In other words, if I were buying a 10-year note, I couldn't buy it as deep of a discount. So what enabled me to buy that note at a deeper discount is because it had a longer term, present value of future dollars. So the further out those payments are, the further I get to go bring them back and discount them. So I see it as an ability to buy it at a cheaper price. This buyer had been bankrupt in the past, right? Now this was called a re-performing note, right? So they had been bankrupt in the past, but they had made that up and brought the payments up. And once again, I on purpose listed long-term twice because instantly people sort of go to, well, I don't want that long of a term investment. Okay. Now I'm going to stay in the underwriting mode for just a moment because we're going to get creative here in a moment. And I don't want you to forget that we did not forget the principles of the first question is, did you make a good investment? Did you ask the right questions? Did you go through an evaluation process? And did you scale it and weigh out the negatives and the positives and determine that you were on top? I could live with any risk, but the good outweighs the bad, right? We don't buy perfect loans. They don't make perfect. Well, I guess they do make perfect loans. If you want about a 4% yield, you can go buy a perfect deal. But if you want some juice on your investment, you're going to buy something with a little bit of hair on it. Okay. Now the hair factor, right, Daniel? A hair factor is a lot to do with how much you can live on a deal. So we always look at the buyer. This is the guy that owes the money. What's the likelihood he is going to pay? Right? What makes you think they're going to pay? Secondly, how much are they going to pay? And then the third is, that's my security. God forbid they don't pay. Right? So this is just think in terms of, this is just common sense stuff, but this isn't anybody in this business. This is kind of how we would weigh it or think it. Now, let me talk about how we've helped my mother-in-law. My mother-in-law is in her 80s. My father-in-law sadly passed away at 59 years old. My father-in-law had taught me the business. I was running my own business. I wasn't working for him. And he passed away at 59 years old. And guess what I inherited? I inherited a business that was a note business, and a pretty sizable note business. So for the past 25 years, we have continued to shift and basically invest for my mother-in-law, her retirement, and we have not gone to stocks and bonds. We've never owned a stock and bond for retirement purposes. We've owned an annuity. But everything else that we've owned, honestly, is either a piece of real estate or a note. And most pieces of real estate, we try to figure out how to turn it into a note. So we've stayed in what we feel like was our business that we understood. We found out for my mother-in-law that we needed to exit the apartment business. Now, that was just in her situation. That's not yours, but in her situation, because they weren't managed the way they needed to be managed, right? And we went through several gyrations of it. And so we took the money from apartments and put that into notes. And we're not negative on that. We're just saying that was for us, that was a good decision. So we have continued to invest in her notes. And that note you just saw, let me ask you, if she has $100,000 in her retirement account, is that a good investment? Would you make that investment? I mean, would you buy that deal? You realize that $1,081 a month times 271 months, you realize how much money that is? That's just almost $300,000 paid back on $100,000 invested and $1,000 a month in cash flow, right? So that's a heck of a deal. And so we bought a lot of notes like that for her, and let's say in the hundreds. So we've continued to do that, and she is really my second mom. She's probably the sweetest person I've ever known. And she's grateful because she just is not going to have to worry about money. But we stayed in our lane. We stayed in things that we really understood. Now, let's just say that you're looking at a situation, maybe you're my mother-in-law. Maybe you got plenty of money. There's no chance, barring something extremely catastrophic, you're going to run out of money. And now all of a sudden you're looking over it going, okay, well, now all of a sudden I want to build legacy. What if I wanted to take my grandkid and take a Coverdell educational account? Or what if I wanted to take my health savings account and I wanted to turn it into a lot of money? Okay. If that's if that's the next step, and I find out that, quite honestly, note school audiences can check yes in that blank most of the time. See, you can't go put $200,000 in your grandkid or your kid's retirement account, right? You can only put so much money in there. And so if you want to do that, then you have to figure out how to crank it up. And so in order to do that, the best way to do it, just like it is with multifamily, is to use a leverage technique. So where would I go find some capital that would help fund part of my note business? And what I found is the guy that used to buy those rental houses. He's bought those rental houses, and after about 3 of them, he's found out that's way more of a job than he was looking for, right? And I know this customer like really, really well, right? And they make great partial note investors. So that's generally where we look for that. And it's the same guys that if you're wholesaling houses, it's the same guys you're selling to. And once again, now this is an extreme example. I'm going to warn you today that this is such an extreme example. I wouldn't go do this 20 times in 1 year in my retirement account. But we did do this. And it is an extreme example, right? And so I've had a lot of guidance and coaching with people in the self-directed retirement account world. And you can do this like once in a while, but probably $1,000 invested versus 100 would be a more realistic investment. But this particular case study is about $100. Now I call this being a deal architect. So I'm going to ask you a question. This pizza, it cost me $6 to make it. I own a pizza shop. It cost me $6 to make this pizza. How can I make profit? Well, if it cost me $6, could I sell the pizza for $12, right? Now, I'll bet you that at least half of you watching this, that you've already answered the other part. And you already said, well, you could sell it by the slice. And the answer is, you are totally correct. What if I could sell that pizza for $2 a slice? If I could do that, how much do I have now invested in the back half of that pizza? If you can do it to a pizza, you can do it to a note. So this concept is unique to the seller finance industry. There's a lot of financial modeling that hedge funds and the smartest guys in the world do. This strategy, ironically, was developed by my father-in-law and his partner. They actually invented the idea. Now, I've done over 25,000 of these, so I've kind of perfected it, right? But this is called a partial. And the idea is, remember that stream of payments over a long period of time? Well, I buy that stream of payments over a long period of time, and then I come in and I sell the front part of the note. Now, generally, mathematically, if I ran a present value calculator, about 90% of the value of the note is in the first half, and about 10% of the value of the note's in the second half. Okay? So if I could sell the first part of the note and come close to recouping my investment, then I could own the backside of that note for an incredible leveraging amount, right? So that's the concept. So we buy this asset for 105. That was a good price, right? Then we turn around, and Martha, my wife, manages this for our family. So she does this for my account, my grandkids, my kids, all different. I think she has 9 different retirement accounts she manages. So she sells 143 payments for 104,900. Now, by the way, for all of you that are curious, that's about a 6% return to an investor. So this guy that's tired of managing rentals can get note payments every month and truly earn a legitimate 6% annualized interest on his investment, right? Yield, rate of return, whatever it is you want to call it. That's a pretty solid deal. And we found a lot of people would far prefer this to having something that took a lot more work and aggravation. Now, here's the good news. We own the back 128 payments of this note for $100. Now, I bet you're wondering, if this investor is getting a 6% yield on his investment of 104, what is Eddie's retirement account's yield on $100? Right? Well, it's very high, right? That's sort of teasing with all my engineers, right? They can't hardly stand it if I can't. Of course, I know how to calculate the yield. You don't need to. I mean, it's $100 and you're going to turn it into 128 payments at $1,081 a month. It's enough. It's good, right? And I always say the best kind of investment is one when you don't need a calculator, right? So we don't need a calculator to know that's good. This is solid. This is a picture of an amortization schedule. Okay, so it's just a picture of how a loan amortizes. It's the principal all the way, every payment to the end. Now, the orange represents the entire note. The blue represents selling the partial. So here's my partial investor, 143 months. And here's our backside of the note for $100 invested. Okay. Now, at the end, if the loan just pays as agreed, at the end, we're going to get the note back and they're still going to owe us right at $100,000 plus 6% interest for the remaining back half of this note. Okay. So then we'll end up getting this 128 payments times 1,081 a month, and that'll be a good deal. Now that's assuming that we go for 12 years. That's 143 months is 1 month short of 12 years. That's assuming we go to 12 years and the loan doesn't pay off, right? In this story, to be honest with you, that's not what happened. In this story, right about here, this loan paid off early. Now, the investor, the partial investor, he's entitled to about $70,000. And the loan payoff was about $140,000. So the investor gets his $70,000, and guess how much Eddie's retirement account gets? About $70,000. So if you had $100 today, and in 5 years, it turned into 70,000, how would that be? So the point is, I couldn't stop the loan from paying off early, but because I bought a longer term note and I fully understood that when I was buying it, I could buy it at a deeper discount, and God forbid it pay off early. Now all of a sudden, think about taking your kids or your grandkids or your retirement account or your HSA, and now all of a sudden you're putting $70,000 in there. And if you use these same leveraging techniques, go take that out 10 deals. Even if you wanted to invest $5,000 a deal, go run the math, right? It's unbelievable, like what it turns into. Now, I didn't make this. I just was introduced into this business. Now I've done this transaction thousands of times because I fully understand what happens. More seller finance notes are created in inflationary times. So I'm looking at the horizon, and what do you think I see? It looks pretty good, right? Because more people are going to need seller finance notes, and I'm going to get a chance to buy more of these notes at a discount. So let's kind of look at where we are. The deal architect. Now, in this case, you can say this is Eddie here. Actually, Martha's the one that quarterbacked this deal. But Martha buys a cash flow of 271 months. Okay. And she buys it, and for that, she gives the note seller $105,000. Okay. Now, this 271 months, as we well remember, is $1,081 a month. So it's got a heck of a payback. And then she comes in and says, okay, well, here's what I'm going to do. I'm going to carve off and sell this much of this cash flow, and it's going to go to this guy here. Now, he's going to get 143 payments times $1,081 a month. He's going to be okay. He invested $104,900, and he's going to get back close to 150,000 plus or minus. So he's okay. He did decent on his investment. He got a 6% return legitimately. What's the chances he was ever going to lose his money? 0. Now, the way that blue amortized, it's as if his 6% investment paid off early. So he legitimately earned 6% return for the 5-year period. And then he got a check for $70,000. let me ask you a question. What do you think that investor wanted instantly is when he got 70,000 bucks? Where's the next deal? So it becomes perpetual that all of a sudden your investors that you do it with, or at least this is what we've experienced, they come back. In fact, they start out with one amount of money and then they keep adding to it. And then all of a sudden they tell their neighbors about it. And that's pretty much how it's kind of works. So it does have a life value. And so if you look at the investment strategy here, Martha took $100 and there's the 109. If you added it up, then that's what made the combine the amount of money to do that. Now, this was a little more of a maneuver because she had to go have an escrow that somebody that was going to fund the note. She had to have somebody hold the escrow of her $100 plus the guy's 104,000, and they had to kind of go do that. So a little bit, some mechanical steps in there, but that basically kind of shows you how it works. What about servicing? Servicing is a big deal, right? So I want this loan third-party service because they don't know how to service a loan. This guy that I'm selling the note to, he doesn't know how to do those things in that checklist, right? So every month he's getting a payment stream and he's sending it on to the note seller, and they really don't have to do anything. I mean, like legitimately, they don't have to do anything. So this is what I've learned. Most people want the easy button. Most people want the passive. That's basically what they're looking for. And it works. So there's Martha's mom. Martha's mom can also invest in the grandkids or great grandkids Coverdell educational accounts. Here's Martha. Martha can do all of the above for us, her and I. Now here's my son, Wood, the fireman, right? He can do an HSA. He can do a retirement account, and he can also fund money into his kids' Coverdell educational accounts. What's the kid get? Well, he's probably going to end up with some of all the above, but he certainly can wake up in a way where you can take an insignificant amount of money and really grow it into it. What I have seen is this. Most people want legacy. Most people lack clarity of how to build legacy without starting out with a big pile of money. Legacy meaning financial legacy, not the other meaningful things of legacy, right? But as far as passing on legacy, most people think you have to start out with this much money to end up with this much money. Well, you would if you couldn't do some financial modeling and really come up with another way to do it. So as I said, we call this kind of being a deal architect. And as I promised you, and thank you all, and it looks like literally we lost nobody. Thank you all. And I promised you a book at the end. And so this book is just an Ask Eddie book. And you just go right there, go to the website and type that in. And then we'll send you the book. It's a digital book. And I think it'll be helpful to you as far as just maybe answering some questions you have. I know, Daniel, you got some maybe questions at this point, because I see you have 27 things in the chat. So let's talk about that.
Let's go through some of them.
All right.
We've got a question from DK. Correction, mortgage notes during inflationary times are great for mortgage holders, but not lenders. Go ahead.
Not if you're buying notes at a discount.
Is
right?
that okay.
Let me tell you this. We hear so much about, you got to go invest in hard assets. Let me tell you something. Hard assets that produce rental income are going to have a hard time pacing inflation. I can guarantee you your expenses are going to go up. I just can't guarantee your rates your rent rates can continue to go up. So I'm in disagreement with you. Like if you look at the most inflationary time in most of our lifetimes, which was in the 80s, then notes proved to be one of the best investments for inflationary times, because I can adjust the yield based on whatever I need to be at market condition. That's why I bought this note at such a discount.
And then I think Glenn has a question about just how do you find such good quality notes? Is it all about relationships, websites? What are your strategies for finding them?
Modern day, we have a website and we have people that are affiliated with Note School, and there's 2 or 3 other good websites where there are notes available. So you don't have to go build a marketing machine to go buy notes. I did 40 years ago, right? But you don't have to have Eddie's connections or Eddie's overhead in finding those opportunities to be able to buy notes.
All right. That's actually all we have in the chat. Let's open it up. We've got 6 minutes left. Let's open it up to people just taking themselves off mute and asking questions. All right.
Oh,
well,
I was
then,
going to get one in, Daniel.
Okay.
Hey, Eddie. So this whole process is very intimidating. Is it a situation where you do one and it's kind of rinse and repeat, or is the complexity and the, I think you said deal architecture, is that the most complex portion?
Well, I mean, this is why I built a school. I mean, if you know, this is a strategy that we have perfected over a period of time. And we've taken every one of these processes, from note evaluation to identifying where a note is at, to identifying how to look at the numbers and identifying what, you know, what the possible, we've taken every one of these components and we've just taken each one of them and we're able to break them down individually, right? Everything's complex till you understand it.
Right.
Right. And so I feel like that, you know, that's why we had to build a school. I couldn't just go sit around in a coffee shop and tell people how to do it. The school is where it like filled in the blanks to say, here's how you actually would go do this. There's no trickery to it. It's just, I can do a lot of business with people once they learn some basic things and how to go through it. So that's basically how it works. I mean, a lot of what we teach in Note School period is we use a lot of different techniques like this to show people how to do it, buying property, show them how to buy notes, all kind of different things. And really, this is just kind of a good basic example to start with. Believe it or not, at the end of the 3 days, you can't believe how much of this stuff you would really totally own.
Great, thank you. I'll download the book and then I'll hit you up for more questions.
All right, thank you.
Any other questions?
Yeah, I have one. What if I wanted to hit the easy button, as you said, and while I learn, go to school? Is that also an option?
Well, the easy button would be essentially just buying a note from somebody like Martha. You'd just be the passive investor, right? And Martha does that, and you can reach out to us, and I'm gonna give you a slightly different path to do that. And you could just go to info@noteschool.com and just say, I saw a presentation on Martha's partials and I'd like to talk to her about funding some. And that way my team could forward it over to her and you could have a conversation with her about it.
Okay.
Mario is asking, what happens if the borrower doesn't pay? What percentage of cases end up in bankruptcy?
Usually you're going to see about 5% that end up in, you know, some form of serious delinquency. Those don't necessarily all end up in foreclosure, but about 5%. Martha has learned that she would rather, Martha tries to buy really clean. So if she's selling a partial, she doesn't have some high risk of a loan defaulting. One of the key things that Note School teaches people how to do is how to grade a note. What is the difference between an A grade note and a D grade note? Like, what components say what's the likelihood a borrower pays? And we're, over the years, gotten pretty good at that.
And then Glenn says, related to Mario's question, risk returns are correlated. Is there a sweet spot of credit worthiness that is the focus for note selections?
No doubt. there's a couple of components here, right? We may be buying a note that has an established pay history for 6 years. I'm not so worried if the guy has a 628 credit score or a 728 credit score if they've been paying and I can see a pay history for 6 years, right? I may be a lot more worried about their credit if they've only been paying for 4 months. So one of the things that we try to do is, you know, and when I suggested like the variables that you look at in underwriting, remember they had the 3 little images. One of them was the borrower, one of them was the note, and one of them was the collateral. Well, I weigh all that out. And we talk a lot about like how to weigh that. Like, what does that mean? And, you know, after 50,000 notes, you get a little bit of a sense of, you know, like, we've sorted through the pile enough that we've kind of learned there are some variables that are more important than others, but credit or likelihood to pay is the ultimate question, no doubt.
And this will be our last question. It's what interest rates have been low for a few years now. How are you able to maintain attractive returns for passive investors?
Well, I mean, the yields for passive investors have gone down. I mean, we generally have been about 5%. You know, we're probably at about 6 today, and we think that's a good market rate. You know, let me ask you a question, rental property owners or people that invested in syndication. I used to could buy an apartment complex here in Dallas-Fort Worth in 2010 at an 8 cap. Now it produces identically the same investment dollars, and now all of a sudden you know, into last year it trades at a 3.5 cap. Now what you would argue is, well, that's the market, right? So it is market to market. And yes, I look forward into this business and think we probably are going to give a passive investor a little more return, and I'm going to buy at a little better return on my end. And so I've been doing it for 42 years, and I've operated in 20% interest rate markets and 2% interest rate markets. So our yields never drop as low as the traditional mortgage industry, but not even close.
All right. Hey, can I have everybody take themselves off mute and thank Eddie for coming in here and talking to us?
Thank you.
Thank you.
Thank you so much.
Thank you.
Thanks, Eddie.
Thank you.
Thank you, Eddie.
Thank you, Eddie. Have a wonderful
Thanks.
weekend, everyone.
Thank you.
Thank you, guys. Enjoyed it.